I just want to warn you, viewer discretion is advised. This is some shocking content that may cause you to run out in panic and buy gold. That's what we're going to be talking about today. We're going to talk about inflation. We're going to be talking about the money supply, what you should do, what I'm doing, and some scenarios, what could happen, what's happened historically throughout time, a little bit of an education on inflation and how it affects you. A lot of you guys don't understand what it is. That's fine. I didn't until I spent some time researching it, maybe about 10 years ago, and now I have a pretty good grasp on it, but it's something you definitely need to know. If you guys are just joining me for the first time, I'm John from Bulldog Mindset.com. On this channel, I teach you how to be a man, how to build financial independence, how to get the physique you want, how to get the girls you want, and how to go from the victim mindset to the Bulldog mindset. Click that subscribe button, smash it, smash the like button as well. Get in the habit of that if you guys don't mind. This way we can grow the channel and take the quiz up here in the cards. All right, so let's jump to the bloodbath, to the thing that you will not be able to unsee once I show you this. This is the M1 money stock. You can just search on Google and you can look at the St. Louis Fed.org here where they publish this. This is a real thing. This is not some made up thing that I made. What this represents is the number of dollars in circulation. Now, what determines the number of dollars? We'll go back historically. Okay, this is over time. Okay. No, this is the actual dollars, okay? The Federal Reserve controls how many dollars are in circulation at any given time because a lot of these dollars just exist in spreadsheets, essentially. That's what they joke, but it exists. They can basically create money instantly. They don't even have to print it, all right? So this is how much money was available. These are in billions of dollars. So you can see, at the beginning of time in 1975, at the beginning of time, when the Federal Reserve was first tracking this, there was $273 billion in existence. Okay. Now you can see what's happened over time. And what I want to bring your attention to is the scary part here, which is 2020. If we go back a little bit here to, the beginning of the thing, that bug that everyone talks about. All right, we're talking about, in February here, $4 trillion. Okay. And then let's just make this chart a little bit easier to see. From 2005, we will look and see what's happened. And you can see that just from the beginning of this bug to now, we're looking at, it went from $4 trillion to $6.8 trillion. And there's another 2 trillion stimulus package. By the time you're watching this video, this number will probably be 8 trillion or 9 trillion, possibly more. Okay. So basically, the money supply, the number of dollars in circulation of US dollars, has doubled in approximately a year. It approximately doubled in approximately a year. Let's say a year and a half. Let's say it'll double in a year and a half. So that's pretty insane. Okay. I think we can all admit that that's pretty insane. And I hear a lot of people denying the truth of the situation. I hear a lot of people saying, hey, John, well, there's all of these things, blah, blah, blah. It's not just straight Austrian economics and that, just increasing the money supply doesn't cause inflation. That's not true. That's not true at all. It doesn't immediately make you feel the effects of inflation, but it does cause inflation immediately. Okay. Now, a good example I could give you is, I don't know, do you have anything valuable? Let's say that you've got something that is valuable to you. Okay. Collector's edition of a thing. Let's say that you had a rookie mantle. Let's say a Wade Boggs rookie card. Okay. Let's say you had, I don't know, a really expensive Magic the Gathering card. Okay, let's say that you have a collectible of some sort that there's only 1,000 of, a signed baseball, a signed football by Tom Brady. Okay, now let's suppose that you've got this. We'll go with a Magic card. Okay, let's say a Black Lotus. All right, for you guys that are Magic geeks. All right, so you have this Black Lotus. Now, obviously, it's pretty rare. Okay, there's not that many of them in existence, but let's say that there's 100 of them in existence, and you had one of them. Okay, one of these 100 ones, and yours was worth $400,000. Would you be upset at all if I was like, you know what? I think I figured out a way I can just make some cash. What if I just start printing Black Lotuses and I print 100 more of them? Would you be upset as someone holding one Black Lotus that was worth $400,000? Would you be upset if I said, well, it doesn't matter if I make more of them. The value is what the value is. And so I print 100 more. Would you be upset by that? Yeah, I think you would. I think you would make the argument and you'd say, hey, John, you're devaluing my Black Lotus. You see, I had to pay $400,000 to get this thing. It's worth $400,000. Okay. And now if you make another one, if you're making more of them, it's going to reduce the value of mine. That's not fair. You can't do that. Okay. That's called taxation. It's called automatic taxation. Whenever the government, any government, increases the money supply by printing more money, they're just taxing you. They're taxing anyone who holds the dollar, because the value of your dollar, regardless of what anyone else tells you, has just been cut in half if you double the money supply. There is no ifs, ands, or buts about it. Now, you might not feel the effect. It might still have the same purchasing power. There may be a depressed means of production, which is making it so that it seems to sustain that value. Basically, you have a depreciation of the assets. Okay, you can have that, which is making it so that or deflation of the assets, you could say, so that you're not feeling the effects. But guaranteed that if you double the monetary supply, you cut the value in half. It's basic supply and demand. All right. If you want some good resources on understanding economics, all right, let's talk about that. The best one I would say is probably Thomas Sowell's book called Basic Economics. I'll just bring this up real quick here. Okay, and I'll put a link here. There we go. Basic Economics, Thomas Sowell. Okay, it's Sowell, by the way, Thomas Sowell. Okay, just so you know how to pronounce that. Okay, go get that book. All right, but let's talk about inflation. Let's talk about what inflation is, so you guys can have an understanding of this. So, what is inflation? Why does it matter? How does it affect you? All of these things. Okay, and what should you do about it? All right. Inflation is this. Inflation basically is when your money supply increases. Okay. So it devalues the value of that money. So think of it this way. Okay. So I've got a gold coin here. All right. Now I've got this gold coin. Okay. So this is pure gold, or 99.9. It's 99.999% pure gold. It's almost as pure of the gold as you can have. All right. So this is 1 ounce of gold. This is worth about $1,900. This 1 ounce of gold here. Okay. Now, here's the deal. If you have $1,900, okay, and it buys you 1 ounce of gold, well, the value of the dollar is nothing. It's what you can trade it for, right? We can look at it in terms of Big Macs. Okay. If a Big Mac was $1, all right, and you had inflation to the degree that you double the money supply, then it would take twice as many dollars to buy a Big Mac eventually. Okay, so then you would need to pay $2 to get a Big Mac, right? So if we look at this gold, $1,800. So $1,800 is equivalent to this gold, or $1,900 with the trading cost of that. Okay, let's say $1,900. Okay. Well, I guess we'll just use a spot price. We'll say $1,800. Okay. So basically, if you double the money supply, okay, if inflation is 100%, okay, which it doesn't happen automatically, the effects of it, then what effectively will mean that you'll need to have $3,200 bills to equal this coin. The value of this coin didn't change. So gold doesn't go up in value. Not really. I mean, gold can go up in value to a small degree, but gold is relative to the other currencies. Gold doesn't really change that much, right? If the dollar becomes devalued, it requires more dollars to buy the same amount of gold. Now, again, it might be easier to think about this in terms of something that is sort of a fixed asset, right? Like a real estate, or let's say a property price, okay? Or like I said, a Big Mac, okay? A Big Mac is where we feel it, okay? So if a Big Mac right now costs you $4 to buy a Big Mac, I have no idea what a Big Mac costs, okay? Then at some point, if you keep on printing money, if you have inflation where the value of that money is worth less, then that same Big Mac will require 8 of the US dollar bills in order for you to buy that. Okay, so that's what inflation is. So when you have inflation, it means that the value of your money has become less, so you need more of it to buy the same thing. Okay. Deflation would be the exact opposite. That would be if the money became more valuable. So then this gold coin, instead of it costing $1,800 US dollars became twice as valuable as they were. And so now it's 900 of them, right? That's if you had a 50% or if you had 100% deflation. Okay. So what does that mean? What does that mean to you? Well, there's a lot of implications of this, okay? So think about this. There's a few things to consider. Okay, so what if you have money in the bank? If you have, let's say, $100,000 in the bank, and then the US government doubles the money supply. What does that effectively mean? It means that your $100,000 just really became the equivalent of $50,000. Okay, now, you might not feel the effects right away, but in real terms, that is what has happened. Just like I used an example of printing Black Lotuses. Okay, if you print a bunch of rare cards, you have to expect that the value will go down on those. They're not as valuable. They're not as rare. The rarity is what makes it. Okay, and so the more that you increase the supply of something, the less value that it has. Okay. Now, of course, in economics, things are complicated. They take time to work through the system, right? What you're seeing is that, let's take stock prices. So what does it mean when you have a high degree of inflation? Well, stock prices go up. Why? Because, remember, just like the gold coin, okay, now, in order to buy that same stock, it requires more dollars. So that stock is valued in dollars, therefore it goes up. Real estate prices go up, okay? What about debt? Here's something to think about. Let's say you owe a mortgage on your house. Let's say you owe a mortgage of $100,000 on your house. Well, if dollars are worth less, then effectively that mortgage could get cut in half. So it's really effective of having $50,000 now that you owe. Now, why is that? Why? Because wages go up, because the value that you could rent the property at goes up. Okay. So in terms of relative values, if you have inflation and you hold a loan, that's a good thing for you. Okay, if you had deflation, you hold a loan, it was a bad thing for you because that means you owe more money. You owe less money when inflation happens when you have a loan. Okay, so when we think about these things, right, again, I'm just trying to educate you guys so you understand how this whole thing works and you can make some decisions based on this, all right? When you think about this, all right, having money in the bank, bad. Having a loan, good, technically, right, as long as you're getting a profit on that loan, all right? Having assets that are tied to dollars, good, right? Because those assets it's neutral. Those things go up, right? Having something like gold, which is an asset that's tied to a dollar, that could be a good thing, right? That's a hedge against inflation, right? Now, the beautiful thing about gold is that because it has intrinsic value, right? It can be traded. It can be given trade for other currencies. It's a good way to store wealth, right? We talk about other things like crypto, okay? So Bitcoin, look at what happened with Bitcoin and Ethereum. That's going up. Now, it's not just going up just because of inflation, but that's part of it, right? Part of the whole theory, the reason why I like Bitcoin and I like Ethereum and cryptocurrency so much is because it is a good store of value. Okay, the best money system is what we call hard money. Okay, the harder money is, that means the less that is affected by inflation, that it's affected by external forces, the less that other people can influence that money supply, the more hard that money is and the better store of value that is, right? See, gold is a really good store of value because not a lot of it can be created and not a lot of it can be mined at any time. So that supply cannot be increased by a large degree. It can still be increased every year by a certain amount based on the mines. It's predictable. Okay. When you look at the US dollar though, unfortunately, right? It's unpredictable. Okay, this is sort of insanity. This is ridiculousness to just double the money supply just like that. That's pretty crazy, right? You don't have control of it. If you're holding US dollars, you just got screwed. Okay, you just got screwed. All right, just like I said. I mean, there's no difference. I just want you guys to understand. There's no difference between the government doing this and someone literally printing a bunch of rare cards that you owned or rare collectibles that you own, creating a bunch more of them, and making them worth less. That's exactly what's happened. Okay, so what should you do? What should you do in this particular situation? All right, there's a couple things, and I can tell you what I'm doing, and I can tell you what might be some good options for you. So first of all, if you have properties with mortgages, if you've already been investing in real estate like I've told you to do, by the way, if you want to know how to invest in real estate, click down below, the link down below to join the Bulldog Mindset membership. I have whole series is on that. In fact, you can get the full course of my real estate course of how to invest in real estate free, my $500 course, when you sign up for the Platinum membership. That's a lifetime membership. If you click the link down, you might just have to go to the Bulldog Mindset site to find that, because right down below is a $7 free trial, or the $7 trial link, not free, it's $7. Okay. But I have a whole bunch of stuff on investing in real estate, big community. We've got over 900 members now. I just raised the price. So the price is going to be going up again pretty soon because there's no slowdown here. Okay. So I have a lot of great advice there on becoming financially independent. Okay. But regardless, what I'm saying is that if you follow that real estate advice and you have real estate and you have mortgages, you're kind of in a good place when inflation hits, because your property values are going up, okay, and relative to the property values, your mortgages are going down. They're staying the same, but as you devalue the dollar, you technically owe less, right? So if you can imagine, as inflation starts to hit into the consumer market, right, how much you're being paid by your employer, that will increase, okay? How much you charge for your services, that will increase, right? How much you sell your goods for, that will increase. So relatively, right, your debt will be less in comparison to that. Everything will go up, but the debt, if it's a fixed mortgage, will stay the same. So that'll be a good place for you to be. Okay. Now, if you're sitting on a lot of dollars, that could be a bad thing. So that's what I was sitting on. I've been trying to figure out what is the best thing to do. So I've put a lot of my money into Bitcoin and Ethereum, of course, and I've had some great returns on that. I've got some huge returns. I did a video. I'm not going to get into the details of it in this, but you can watch the video on Bitcoin and Ethereum. In fact, I should do a topic in the Bulldog Mindset membership. Click down below to join. I'm going to talk about cryptocurrency in there. I'm just going to make a note here to put that in the financial section. Let's talk about money, crypto. Okay, so I'm going to be doing a more extensive video on that. But so that's one place that's a hedge against inflation, again, because if inflation hits, or when it hits, that supply, the cryptocurrency, should go up in value, because it again, you're buying the cryptocurrency in terms of US dollars. So anything that you're buying in terms of US dollars, okay, if US dollars takes a hit, all right, that asset is going to rise in comparison, right, to if you want to get back into US dollars, okay, because those US dollars have decreased in value. So you're getting out of the thing because you want to move from something that is being inflated to something that's being stable. Okay, so the cryptocurrency is not super stable, but in effect, it's stable, as in the supply is stable. Okay, whereas the dollar is not. So you move into cryptocurrency, let's say, that's stable. Okay, and then after the inflation happens, then you can move back into the dollar, and you're fine. All right. Same thing with gold. Okay, the other thing I'm doing is I'm buying both physical gold as well as buying gold, the gold ticker, the GLD ticker. Okay, some differences here. There's some significant differences to think about as far as gold. So one of them is that, the GLD that you buy on the stock market, all right, it is not it is not your physical. You can't demand physical gold unless you own a very large amount of it. Okay. So it just represents the price of physical gold. It doesn't follow it exactly. Okay. And there's fees, right? It's a fund. Okay. So the other thing I would say about it is that if the shit really hits the fan, it's not, you have to get that money from someone. Okay. Right. So you have to be able to get onto market and sell it to get your US dollars back. And you might not want US dollars. It might be completely worthless. You're not going to be able to trade it for something else. So it could be dangerous if the financial system collapses. Having gold, ETF is not going to do you much good. Okay, but it is a good hedge against like a non-catastrophic failure of the financial system if things really start to heat up, which I'm imagining they will. Physical gold, on the other hand, wherever you want to hide them in orifices, you can do that if the shit really hits the fan, and you can take them to another country. My preference would be, I think I'm going to bug off to Switzerland. Okay, stable country. All right, and trade. They like gold there too. Trade the gold for Swiss francs, and then live the good life. All right, so that's sort of the plan there. And then the last thing that I'm doing is I'm investing in businesses, right? My own business, okay, growing that, advertising in other people's businesses, right? Syndications. Actually, this hat is one of the SureSwift Capitals, one of the companies I invested in. They do like SaaS companies, and they buy up SaaS companies, But yeah, you need to have some kind of plan. Think about what's going to happen. Again, I want to show you this chart one more time because I want to scare you, because I want you to think about this, and I want you to figure out, okay, do a little bit of research. Okay, what I'm telling you about inflation, you need to understand basic economics. Okay, the Austrian economics is the correct economic theory. Again, Thomas Sowell, read his book. Okay, Basic Economics, and you'll understand this a little bit better. And, just prepare. Okay. Prepare. Think about what's going to happen. All right. And, if you're sitting on a bunch of US dollars, okay, you need to do something about it. Okay. Real estate prices will probably drop as, and I think stock prices will eventually drop as well as that bubble bursts. But when you think about it, it's like, where's the money going? Okay. So a bunch of US dollars got created. Okay. And some of that went into citizens' hands in the form of checks. Okay. But a lot of it just went into securities, went into the market. The government started buying stocks. Okay. And so they bought a bunch of assets. So they pumped up the value of those assets. Okay. So what's going to happen when people try to take that value out? They're going to extract the value. They're going to sell the assets. Okay. There's going to be a sell off at some point. Prices are likely to crash. And then all of that extra money, where's it going to go? It's going to go into consumer goods. Okay. And that is going to inflate those prices to a large degree. And then that's when you're in trouble. That's when your dollar really has less purchasing power. Okay. It has less purchasing power in stocks and real estate right now, but eventually it'll have less purchasing power in Big Macs. Okay. And when it has less purchasing power in Big Macs and rent, that's when you're going to be in big trouble if you aren't prepared for this. Okay. And just to give you another scare here, all right, throughout history, there have been hyperinflation scenarios, okay? In fact, if we look at hyperinflation, let's look at some examples here, okay? That maybe we can see a chart here, whatever. Germany, okay? Germany is a good example, all right? By the end of 1923, it increased by billions of times, okay, of German marks from the outbreak of the war to November 1923, German Reichsbank issued 92.8 quintillion paper marks. Quintillion. Okay. In that period, the value of the mark fell from about 4 to the dollar to 1 trillion to the dollar. Okay, these are real numbers here. From 4 to the dollar to 1 trillion to the dollar. Imagine what happens if you're a rich man and you've got all of your assets in German marks. You are not a rich man anymore. You are a poor person now. Okay. Venezuela, another example, prices rose 41% in 2013, and by 2018, inflation was at 65,000%. Okay. In 2017, the government increased the money supply by 14%. What have we increased it by? All right. Zimbabwe had hyperinflation between 2004 and 2009. The government printed money to pay for the war in Congo. Okay. So as a result, hyperinflation was worse than in Germany. The inflation rate was 98% a day and prices doubled every 24 hours. It finally ended when the country changed its currency to the US dollar. Okay. United States had hyperinflation during the Civil War. Okay. When the Confederate government printed money to pay for the war. You've probably seen that. And yeah, so you should be prepared for this. Okay. Definitely think about these things. Again, if you haven't looked at joining the Bulldog Mindset membership, do that. We're going to be preparing together for hyperinflation, doing stuff like that inside there. So I definitely highly recommend that you join us and, educate yourself on this. Like I said, read the books, understand what the risks are, and, don't ignore the signs. Don't believe that this can exist and not have an effect on you. That is just, look at throughout time, look at how much money was created. Okay. And then look at this and try to pretend like this is not going to affect you. Okay, I dare you. All right, don't do it. All right, think about this. All right, guys, I know this hasn't been your usual video, but I just wanted to warn you about this, just give you a little bit of a background on this. Hopefully you should have a good understanding of what inflation is at this point and understand what its effects are. Again, like I said, easiest way to think about it is to think about in terms of how many Big Macs can you buy?